You have good income, you have money saved, and you're still getting denied for credit. And this is one of the biggest issues that most people run into is that they don't realize that their good income does not automatically qualify them for being approved for credit. And so what we have to understand is that in the financial space, we have our income, the money that we make, but we also have the debt that we currently hold. And you'll commonly hear the phrase debt to income ratio, which if you know anything about finance, this is extremely important. Your debt to income ratio ultimately is what allows you to be an eligible borrower for debt. And so this is where we need to sit and understand for us to have a great credit score, for us to have great financial health. And so you probably hear the stories all the time about athletes. They have great income, but then eventually they go broke, right? Because they're spending much more than what they actually have access to. A lot of times they get into debt. Maybe if you're familiar with the Floyd Mayweather situation, he's in a lot of debt right now, and he has a lot of creditors currently pursuing him, right? So even though his income is great, if his credit is terrible, even though he, probably has a bunch of assets and all of these things, he probably has a low likelihood or a low chance of being approved for capital again because of his current financial situation. And so you may be in a similar situation, maybe not the same scale, but maybe you have great income, but you have high debt. And so that's going to lead to you not being able to be approved for credit. And so we see this in a lot of different situations. For example, let's say you're applying for a mortgage, but if you just got approved for an auto loan and that auto loan is maybe taking up 50% of your income, which sounds crazy, but it happens to a lot of people, then your likelihood of getting approved for that mortgage is going to be extremely low. And so if you're working with a mortgage broker, a lot of times they'll tell you to hold off on applying for any other products until you get approved for the mortgage because they understand if you add on any more debt onto your personal credit file, then it's going to lessen the chance of you being approved. And that's because mortgage brokers understand that the banks have certain criteria that you need to fill for them to be able to lend you a mortgage of, again, around 600K, 700K, which is like the average going rate for a home here in Montreal, Quebec, or pretty much across Canada. Now, understand if you're in a position to where you have great income, but you have poor credit, the first thing is you need to get access to your credit reports. And so here in Canada, we have two credit bureaus, the first being TransUnion, the second being Equifax. Now, for these two platforms, you do have to pay a monthly fee. It's around somewhere between $25 to $30. If you do not want to pay that monthly fee for those platforms, there are alternative platforms. We have Credit Karma and we have ClearScore. If you live in Quebec, you will not have access to ClearScore. But outside of Quebec, you do have access to ClearScore. So Credit Karma, ClearScore is going to give you access to your TransUnion score. And then we have Borrowwell. Borrowwell will give you access to your Equifax score. So again, these three platforms are free platforms that you can use to monitor your credit score. As soon as you get access to these platforms, ideally you have access to the at least Credit Karma and Borrowwell. As soon as you have access to these platforms, what you need to do next is carefully comb through your credit report, starting with your active accounts. Okay, your active accounts, usually it's going to start with the revolving section first. Your revolving section is typically your line of credits and your credit cards. Ideally, what we want to check here is that we don't have any late payments on any of our active accounts. So when we're checking our active accounts, our revolving section, we want to make sure we don't have any late payments. The second thing is with these credit cards, we have to ensure that our utilization is extremely low. If you're online, a lot of people are going to advise to 30% utilization. 30% is the bare minimum. If I had to give it a grade, it's like having a C on a test. Ideally, we're anywhere between 1 to 10% as far as utilization is concerned. And this is when we're trying to be extremely aggressive and trying to have great credit. So if you're in the position to maybe you're planning over the next year to apply for a mortgage, then you want to start prepping to be in this 1 to 10% range as far as your credit score, your credit utilization is concerned. Now, if we go to the open section or installment section and open section, these again are your utility bills. So in the open section, you may see phone bills here, you may see hydro bills here. If you're in the installment section, this is typically your loans, your auto loans, things of this nature. Here, it's extremely simple. All we need to make sure is that we don't have any late payments on your credit report. Okay, next, we are going to have the closed section. Okay, closed accounts, this is where it can be a bit confusing for a lot of people. In the closed section, if you have any accounts that are carrying a balance, this is an issue because you have a high likelihood of that account being a charge-off account. meaning that that creditor closed the account, wrote it off as a tax write-off, and they possibly will be selling that debt over to a collection company if they do not have internal collections. You may also notice that on this account, it has a rating code of a 9. Okay, you may notice a letter in front of it. So if it's a revolving account, you'll see R9. If it's an installment account, you'll see I9. If it's an open account, you'll see O9. Okay, this lets us know what's the current situation of it, what type of account this is, and the current situation of that account. If you have a charge-off account, my best advice is to be discharged from this account, meaning you need to work with that original creditor prior to them selling it to a collection company. Pay it off. Now, typically with charge-off accounts, that you're going to notice is that there's at least going to be around 5 to 8 late payments tied to this account. Once you're discharged from that charge-off account, you need to start the disputing process, ideally trying to entirely remove that account off of your credit report. It does us no benefit, no favor to keep that account off of your credit report, mainly because of the rating code tied to the account and all of the late payments tied to the account. So ideally, we get discharged first from those accounts, and then we start the disputing process and we work towards getting those accounts removed off of our credit report. Okay. Now, the next section is going to be the public records section. Public records is going to house if you have any collection accounts, if you have any judgments. So if you've been sued and you've been ordered to make payments towards that debt by a creditor, it's going to have records if you have a consumer proposal, which is a soft bankruptcy. It's going to have records if you have a bankruptcy, a hard bankruptcy, or a debt management program. Now, I'll start with the collection accounts. If you have collection accounts, okay, these accounts, now with charge-off accounts, you want to be discharged from. With collection accounts, we want to get proper proof of debt first prior to paying them. If a collection company is able to produce proper proof of debt, then you want to negotiate what we call pay for deletion, where we pay what we owe in full, and in return, we get that account fully removed off of our credit report. But in the event that the collection company cannot produce proper proof of debt, then they are not eligible to report that account onto our credit report, which then allows us to successfully remove that account off of our credit report. If you have a consumer proposal, a bankruptcy, or a judgment, it's ideal that you get discharged and that you start the disputing process similar to what we would do with a charge-off account. Now, the last section is the inquiry section. Ideally, we're spacing out our inquiries 6 months apart. If you have a bunch of inquiries within a 6-month period from each other, then that makes our credit profile look extremely desperate. And so ideally, what we're doing is we're spacing our inquiries out. But let's say you went to a dealership and you apply for a vehicle. This happens a lot of times. If you apply for a vehicle, usually that dealership has a partnership with a bunch of different lenders. And so they'll run your credit through a lot of those lenders. Okay, now what Equifax and TransUnion, they actually do is that if you notify them that you were only shopping for one product, they'll remove a lot of those inquiries, and they'll only let the inquiry that you were approved for stick on your credit report. And so one dealership can add 10 inquiries onto your credit report, and each inquiry can drop your credit score anywhere between 3 to 6 points. And so that adds up over time, right? Just that right there is 30 to 60 points in a drop in your credit score. And so when you know what to look for, when you know how to identify the negative accounts and you know how to dispute those accounts, then that's when you can actually take positive steps towards fixing your credit. So understand, you just having good, and this, I understand this is a lot. You just having good income is not enough. I've worked with clients that do well financially, that are business owners, but they struggle in the credit space. And so a lot of times they come to us for help with their credit. Now, if you need assistance with your credit, me and my company would be more than happy to help and to assist you. You can always send us an email, info@kennyjohnsonuniversity.com. And until next time, peace.